Now, after candle science part 1, we need to go over order flow and also part 1. So first, let's refresh our mind a little bit right here with a refresher. Candle science, what did we go over in the previous educational video? Now, with candle science, we again marked out all those PD arrays, right? So every single one imaginable on all the time frames. I advise to stick to 2 time frames in the beginning to not make it too overwhelming. But we marked out a lot of PD rays. And when we looked at those PD rays, we could see the candle delivery, so that candle direction again. We could see that through respect and disrespect, and important as well, 2 candle rejection, right? So we can see through the previous candle what the next candle will likely do, what the highest probability thing is for the next candle to do based on the PD rays, the respect, disrespect, and the 2 candle rejection right there. So then the question becomes, and I can understand that this question arises, so why does this actually work? What is going on in that candle science? Well, it's not just something random. Candle science is order flow seen through a singular candle. So what does that exactly mean? And before we can fully dive into that, we need to again understand order flow. Now, right here, what then is order flow again? Order flow is PD rays holding towards one side. I've written it fully down because it's quite a lot right there. Order flow is PD rays holding towards one side of the market. So for example, if discount arrays are holding, that is bullish order flow. If bearish or premium arrays are holding, that is bearish order flow. So PD rays holding towards one side of the market, either bullish or bearish, that is bullish or bearish order flow. Now, the unloading of orders and adding new orders at PD rays. So for example, I had an example here on the right and also below us right there. And on the right, this is one example that we used in candle science as well. This is Australian dollar, US dollar, where at that order block, we are unloading orders right there. And at this fair value gap, we are now adding new orders into the market to continue higher. And this example right here, this GBP Canadian dollar, I took that screenshot last night again, and I marked out that line as unloading. And I marked out that line, the fair value area with the fair value gap right there, as adding. And that means that I'm expecting higher prices right there based on order flow. So the unloading happens there, the adding happens there. Why does that happen there? Why does the unloading happen there? How do we know we are adding orders on the other side? All things we're going to go into. So for example, if we unload more orders at premium arrays, like we're seeing in both examples, we are unloading orders at premium arrays. We are not adding new orders. How can we know that? Again, what we're going to dive into. So then adding more orders, and we add more orders at discount arrays than we unload, like we are seeing again, that means we have a bullish trend. So the way I want you to see this is very simple. We don't need to go too in depth on that. It's just to have the overall logic is that at the unloading lines right there, at both the lines, at the premium arrays right there, the market is taking off orders. And when the market is taking off orders, you might think, well, that also leaves space to add in new orders. But those new orders are not strong enough. Why? What we are doing right here, we are basically, all that we're doing is following big orders. We're following the big guys. Let's put it that way. We are following the big institutions, the big central banks that actually move the market right there. So unloading orders is them taking or mitigating positions. They are taking orders off the market, not adding new orders. So adding new orders will of course leave a bigger footprint behind, because that is where we need to go over the next part. When we unload and we add new orders, we leave behind certain signs. So order flow dissected. How can we know we are unloading or adding new orders? So how can we know if they are essentially removing orders or if they are adding new orders into the market? So what is their position essentially? That is told through fair value gaps. So are premium arrays or discount arrays holding? And what then does holding mean? What does it mean if a discount array is holding or is being respected essentially? Holding means creating new fair value gaps. So if we go back one slide, right here, when we come into this 4-hour fair value gap right there on the right side, then when we are holding, that means we are creating a new fair value gap off of that right there. So once we came below that swing low that we see right there, how can we know if that swing low is actually holding? Well, first sign right there is that we are creating a bullish fair value gap sitting right there. That means that the intention is also bullish. So going back towards this slide, fair value gaps show the intention of order flow. So fair value gaps are the only way to measure intention objectively. So in the market, if we want to continue higher or continue lower, there will always be some sort of signs that are left behind. That sign is displacement. Now, displacement equals fair value gaps. Fair value gaps equals displacement. And displacement basically seeing there's an aggressive price movement, which in itself is also a fair value gap. Those fair value gaps are essentially the footprints. They are essentially the signs that the market must leave behind. It can't move fast without leaving behind fair value gaps. So that also tells us what the actual order flow is of bigger institutions, of bigger banks, because they are leaving behind signs. If you are in control of the market, let's put it this way. If you are in control of the market and you would like to, well, add on new orders, remove old orders, etc., and at the places you want to add new orders, you would likely want to have price move very fast away from where you place that order, right? So, well, simply because I think we all like when we place an entry and it immediately hits our take profit. That would be a utopia if we can have that every single time. So if we place an order, ideally we want to have it move away fast from our entry level of course, in the direction of our overall take profit. So that leaves behind fair value gaps because that is the fast price movement. And when we mitigate those orders, when we take off orders, we do not necessarily care what is about to happen. We unload those orders. So it doesn't have to move fast because we are also not adding new orders. We're not adding new pressure to the market. We are relieving pressure from the market as well. So this is where we now need to go over the visual order flow. So what does order flow actually look like? How can we fully understand it from a chart perspective? First thing we need to understand is an order flow lag. A lag with an FVG in it. A bullish example is a swing low followed by an FVG. So an order flow lag is quite simple actually. If we take a look at this marker right here, GBP Canadian dollar on the daily time frame, and we see this swing low, and this swing low leaves behind a fair value gap right there. Perfect. So when should it create a fair value gap? It should create a fair value gap before it creates a new swing low. That means it's an order flow lag. So for example, right here, when we create this swing low right there, we do not have a new fair value gap higher because before we create a new fair value gap higher, we have a new swing low. So that means that right there is not an order flow lag. This right here is not an order flow lag right there. Now that fair value gap again should be on the same time frame as the swing low you are looking at. So in this example, again, this swing low, we don't want to go into the 4 hour, into the 1 hour to find a fair value gap because there will always be a fair value gap that defeats the whole premise of order flow. Then we're just forcing it. So we see again, this swing low leaves behind a fair value gap. That in itself is an order flow lag. Order flow lags are higher probability of actually holding right there. When we have a fair value gap in the lag high right there, that is higher probability of holding. Then right here, swing low again, and a new fair value gap left behind there as well. Now, we do not need to create, in a bullish example, we do not need to create that swing high right there. That does not matter. The only relevant thing is the swing low and the fair value gap. So I see oftentimes that people are too focused on a lag is from a swing low towards a swing high. Yes, but that's not super relevant because again, this in itself is also an order flow lag right here. Then when we create a new swing low, we have the chance to create a new order flow lag as well. Does not matter if the high right there in a bullish example is actually swing high already or not. So if we take a look at some bearish examples, this, for example, right here is a bearish order flow leg. Swing high, and then from the swing high, right there, we also leave behind a fair value gap sitting right there, even two fair value gaps, a little bit higher as well. So that is exactly what an order flow lag is. So then the next question arises, which is how do we actually go about confirming order flow? So one fair value gap higher or one fair value gap lower does not necessarily mean that order flow in itself is already confirmed. There's quite a lot of different things going into that, which we're also going to dive into how we can know and have a perfect understanding of when order flow is confirmed. But the basis of order flow being confirmed is the following. To confirm, we have a first order flow leg higher right there. We have a PD array and we have a third order flow leg right there as well. So what does that actually look like? What do I mean by that? All right, here, the same example with this order flow leg higher right there. We are leaving behind PD arrays. And those PD arrays are the fair value area right there. We have the fair value gap itself sitting right there as well. And what else do we have? We also have, and then after the fair value gap, we have the last point of the PD arrays. We have the liquidity right there. So in a lag higher, we have, again, those PD arrays dissected. Fair value areas, fair value gaps, and we have liquidity. Of those PD arrays right there, if they get respected, and we then get a new order flow leg higher, and what is an order flow leg higher again? That is a swing low right there, ideally a swing low. We're going to go over different forms of moving into PD arrays as well, but let's just stick to a swing low right now. Then after that, what do we see? We get a new fair value gap higher right there. So as soon as this candle right there is confirmed, that indicates that we have a new fair value gap higher. That indicates that we have a new order flow leg higher right there. That indicates that order flow right now is actually confirmed to continue higher. Because what was, again, the definition of order flow? That unloading and adding of orders, but more importantly, if we want to understand what the overall order flow is doing, then simply said, it's PD arrays holding towards one side of the market. So a big mistake that I see oftentimes is where people see one huge fair value gap going higher like this and expect the market to just continue higher. That's not necessarily the case. If we only have one fair value gap going higher on any time frame, then right there, that might just be manipulation. Why? Because order flow is never confirmed. If we only move higher or lower, then if we have, for example, let's put it this way. If we have been having bearish order flow right there, and we have one move higher like this, that does not necessarily mean that we are now bullish, because we don't have bullish order flow. The last signs that we had of order flow were always bearish order flow right there. So to confirm the bullish order flow, we would want ideally to see a discount array being respected right there to actually continue higher. And then we can say, we can argue, all right, now we are actually being bullish. So to confirm it again, let's go over it one more time to ingrain it into your mind. We have a first order flow leg. What we want to see is a retracement into a discount array for a bullish order flow leg right there. And afterwards, what we want to see is a new fair value gap higher off of that right there. So for example, bearish order flow right here, we have an order flow leg right there. We create this bearish value gap, also create that bearish value gap right there. Doesn't really matter which one we are coming into as long as we retrace into a premium array right there and then create a new fair value gap going lower to confirm order flow. So right here, what are we seeing? We create this new swing high, but we do not create a new daily fair value gap lower. So order flow, bearish right there, was never confirmed. It was never confirmed there was any sort of bearish order flow, which also why we overall continue higher right there. So that is extremely important to understand as well, how we confirm the order flows, etc. is also what we are, of course, going to dive deeper and deeper and deeper into. This is the very basis understanding. Now, the last visual explanation right here, before we dive more in depth as well, is the relativity theory. And the relativity theory is all about time frames. So what I mean with the relativity theory is that order flow is different on any single time frame that you are looking at. So order flow might be bullish on the 4 hour, order flow might be bearish on the monthly, might be bullish again on the 1 minute. It's different on any time frame that you are looking at. The order flow lags in itself are also different. So the relativity theory states again, all the time frames need to be in context. What does that mean again? Now, we went over the time frames in the previous video, the previous education video in candle science. We briefly went over it again. How we exactly combine the time frames, still what we're going to go over, but we understood the time frames that we are using. The monthly, the weekly, the daily, the 4 hour, the 1 hour, the 50 minute, 5 minute, and 1 minute. And from those time frames, we can again rank them. It's a hierarchy where the monthly is simply the strongest time frame of those particular time frames. After that, the weekly is the strongest time frame. After that, the daily. After that, the 4 hour. So you can probably already guess that if we have a monthly order flow lag going higher, then that order flow lag is going to be the strongest order flow lag. After that, the weekly needs to be in context of whatever the monthly order flow wants to potentially do. After that, the daily needs to be in context of whatever the weekly wants to do. And the weekly needs to again be in context of whatever the monthly wants to do. So everything should be in context of the time frame above it. Every time frame is in context of the time frame above it. That is how we can get to the best understanding of order flow. So what does this actually look like? On GBP Canadian dollar, right here, if I remove these, then at every single one of these order flow lags right there, we see that it is already, on the daily, it is already one leg higher. It's in context of the weekly and the monthly. Now, if we go down a singular time frame, then oftentimes what we will see is that these fair value gaps right there, those order flow lags, because this right here is the bigger daily order flow lag, inside we have 4 hour order flow lags. So for example, this one right there. That 4 hour order flow lag is currently not in context of the daily order flow lag. Why? Because this fair value gap right there is below the 4 hour order flow lag right there, which makes the 4 hour order flow lag already low probability. And that is why we do not see it hold, because there's something on the higher time frame. This 4 hour order flow lag is not in context of the daily order flow lag. It's the daily order flow lag we can retrace into this fair value gap right there. That is exactly why we see an order flow lag like that getting swept as well. That is extremely important. And we can see that that happens quite a lot of times. If you would go down time frames and we, for example, go into the 1 hour, then we will see we will have different order flow lags continuing higher before we retrace back into the overall bigger order flow lag, which in this case is the daily order flow lag right there. And those order flow lags, again, they are low probability because they are simply said not in context of whatever the daily order flow lag is doing as well. So that is the same case, for example, with this right here, this new order flow lag, where we create that swing low right there, new fair value gap going higher, new order flow lag right there. And then after, on the 4 hour and on the 1 hour right there, we might see that we have an order flow lag going higher right there. That order flow lag is not in context because we have, again, a daily fair value gap, a daily order flow lag below that bullish order flow lag. So we always need to make sure that every single time frame right there is in context of one another. All right, so we have the basic understanding right here of the order flow visual. Now we can get a bit more in depth. I do not want to push it too in depth just yet. I want to go over order flow part 2, maybe even part 3 as well, to dive into the small little details. But we can go over the basics of the in-depth version, let's put it that way. So with order flow, we are always focusing on recent lags right there. Order flow is only the most recent lag on the respective time frame. It is not about, we don't add orders on random PD raise all the way towards the left. And what that exactly looks like is what I'll show you in 1 second. If not, and this is what you'll hear me say quite often, if not, it's not part of current order flow. So what does that actually mean? Well, if we take a look at the chart, when we look at NASDAQ right here on the monthly time frame, then we will see we have order flow right there on the monthly continuing higher. Now, we leave behind a few fair value gaps right there on the monthly. Perfect. Let's just get some context over on the monthly, what we can do. Now, order flow here is just bullish. So on the weekly right here, if we find bullish order flow legs that are in context of the monthly, we can perfectly find trade those. Now, right here, we have this fair value area right there. And this fair value area is what we can continue higher off of with the fair value gap as well. To be specific, the order flow lag is this on the weekly right there. On the weekly, this is the order flow lag right there. Now, the argument could also be, well, it's not really in context of the monthly right there, is it? Because this is a monthly fair value gap. That is correct. But this monthly fair value gap, I would not expect a retracement into it in the first place. Why not? Because of candle signs. So understanding if we do retrace into that fair value gap is already important. Now, that is quite advanced. So we're going to also dive deeper into that later on in part 2. But right here on the weekly, this is the most recent order flow lag. So whenever we are looking at price to continue higher, continue lower, then we are always looking at the most recent order flow lags. So for example, once we continue higher off of this right here, then we have this swing low being created and that fair value gap then being created as well. This creates, again, a new order flow lag right there. But it's important to understand right here that this is the area that we are looking to trade off of. And the reason this is super important, those recent lags, is because oftentimes people will go towards the left right here and they will dive into the lower time frame right there to find any entries. Under specific conditions, this is all right to do. But as a general rule of thumb, this is not part of our current order flow. Why? This is a very old order flow. That order flow is not relevant anymore. That order flow is relevant to unload orders, but not adding new orders. Why? If we are looking at order flow, we are looking at what current orders are doing in the market. Meaning, if we place orders, etc. in the market, then we might have very old orders all the way towards the left right there. But what our recent orders are doing is more important, because right here, our recent orders are creating bullish order flow right there. So we want to keep on adding towards that bullish order flow right here because it's the most recent lags. So old premium arrays that are not part of our current order flow, meaning that are not part on any time frame right here of the swing high with a fair value gap or swing low with a fair value gap, there's no order flow lags that we need to take into account right there. They are simply used to unload orders, not used to push price lower all the way. That is where the current order flow comes in. Current order flow will always tell you if we want to push higher or push lower, not old PD rays all the way towards the left side of our chart. That is quite important to understand because I see a lot of times people, and I've also been there, so don't worry, where I would mark out all the PD rays towards the left side of my chart right there, and then just go into the 1 minute time frame and just, well, hope for the best. And oftentimes that did not work. Why? Well, then the argument becomes for a lot of people, well, the trend is your friend. But the trend is very vague. Then what is the trend? The trend here is simply order flow. Order flow creates the actual trend. So order flow right there is your friend. I know trend is your friend sounds sounds nicer to the ear, but order flow is your friend right there. That is extremely important to understand. Now, after we understand that it's always the recent lags, then the FVG, new FVG, that's what I have written down right there. That might be a little bit vague. So fair value gaps should always create new fair value gaps. So what does that mean? Previous order flow lags should create new order flow lags. And that's essentially stating that fair value gaps, and when we trace back into those fair value gaps, we should create new fair value gaps. In other words, an FVG should create a new FVG. Because again, let's think about this from an order flow perspective. If order flow is still bullish and we come back into a bullish fair value gap, into a bullish order flow lag, then ideally we should create a new bullish order flow lag off of that to signal that we are indeed still bullish. So what does this look like? So back on GBP Canadian dollar right there, with the understanding that fair value gaps should create new fair value gaps. And if we take a look at this bearish example actually, with this fair value gap, we can see that when that doesn't happen, we might get an overall shift of order flow right there, which in this moment in time takes a while. But then eventually the shift becomes this, and this fair value gap alone. Now, that fair value gap alone, again, is that enough to take a trade off of? Well, it's a lower probability to take a trade right there off of that fair value gap than it is off of this fair value gap. Because now, after this fair value gap, we actually have order flow confirmed right there. So this order flow confirmed right there is where we create a new fair value gap. And afterwards, we sting into this fair value gap, and what do we see? We do not create a new fair value gap higher off of that. All right, what do we do at that moment in time? Do we now look at bearish prices? That is definitely a possibility. But there is still quite a lot of things going into that. Where, for example, if we would want to look at bearish prices right there, we would need the right confirmation of a premium rate, which we currently don't have. Now, what that exactly looks like, again, that's where part 2 comes in. But right here, just to understand this, just because we don't create a new fair value gap right there, at this moment in time, what has the order flow been doing? Well, order flow has always been bullish. So just because we failed to create one fair value gap higher right there, again, does not mean that we can now look at all the shorts in the world and we can look at lower prices like this and place every single trade to continue lower. That is also what I want to warn you for, because there's quite some specific things that we need to go over first right there, which we will go over, but not in this part. So then eventually we do create a new bullish fair value gap. Why? Because overall, order flow has not changed right there. Order flow has always been bullish right here as well. So that is where I want to go over one more example as well. Right here on Euro New Zealand dollar, we see the same thing. We have bullish order flow right there. Daily fair value gap respected, new bullish daily fair value gap right there. That is bullish order flow. So what do we see? Well, we come into this fair value gap right there. We try to push higher and we fail to again create a new higher fair value gap off of that. No bullish fair value gap is being created. That indicates, again, there's a lack of intention. There's somewhat of a lack of intention. So how can we then see if we want to continue lower or still continue higher? Exactly what we're also going to go over. But this first phenomenon is important to understand. Off of previous fair value gaps, we should create new fair value gaps as well. So that leads you to an understanding of you can mark out fair value gaps before they are being created to see if we will actually create that fair value gap. So for example, right here, why you will oftentimes see me mark out fair value gaps before they're even created, because eventually, if it then doesn't happen, I will see that, and that will again be suspicious to me. And then it will be a reminder, hey, we failed to create a new fair value gap right there. Again, that new fair value gap being created should again be on the same time frame, right? I'm talking constantly about the same time frame right here when I talk about this order flow lags and a new fair value gap being higher created as well. It's very important because, of course, lower time frame, we will have a new fair value gap higher. Now, from those order flow in depth, again, I would argue it's still quite the basics right there. We will go way more in depth later on as well. But next thing we need to understand is candle signs. And candle signs, like we mentioned very early in the beginning actually, is order flow seen through a singular candle, where right now we can actually digest that, we can actually dissect that and go further into that as well, because now we have an understanding of what order flow actually means. So how do we look at order flow from a singular candle? Well, let's first refresh our mind a little bit again. What are the candle signs? So we talked about this exactly the same slide as in the previous video. We talked about that respect and the disrespect. A PD ray is being respected. It's wicking right there. And then disrespected is a PD ray is being disrespected. It's a big body right there. Well, if we look at this from a daily standpoint, then for example, if we take a look at the 1 hour, if we take a look at the 15-minute, we will see fair value gaps instead of actually focusing on those singular candles. So what does that then look like? Well, what do we see on the next slide? When we talk about candle signs from an order flow perspective, right there, so the combination of those, this is exactly what the previous slide would look like. So we have respect right there, which is fair value gaps going higher first, to then bearish fair value gaps coming out of it right there, with the same line being the same premium array right there. Disrespect, same exact line right there, with now bullish fair value gaps instead of creating bearish fair value gaps. So instead of creating potential bearish order flow, here we just have bullish order flow continuing higher. So again, to show you the comparison, this again that is what it would look like if we just look at one candle right there, and same for the disrespect. And this right here is what it would look like if we look at it from order flow on the lower time frame right there. If we look at that from a fair value gap perspective right there. But Candle Science is already looking at it from a fair value gap perspective. So this is where right now it becomes extremely important to understand the following, because I can now understand if there is some confusion, because when we come out of a premium array, let's say this one right here, and we overall have bullish order flow continuing higher right there. We come into a premium array and we respect it like this, then you could argue, well, don't we have order flow right there on the lower time frame to continue lower? So shouldn't we look at bearish price action right there? This is where we now need to understand again how we combine those time frames. And time frames truly is, I hope you can see that, such an underrated aspect in overall trading. Time frames is the toolbox that we are dealing with. It's super important to understand how we combine those as well. So what are we looking at right here? On the left side, this might seem familiar because this is GBP Canadian dollar. On the right side might also seem familiar because this is Euro New Zealand dollar, both what we went over, but both are different examples. On the left right here, I marked out the unloading of orders. That is a swing high. I'll show you what that looks like as well a little bit later on. But that right there is a swing high. And that unloading of orders is seen through the respect right there. Can we see that respect? What we talk about in candle signs. So that is what? It's lower time frame fair value gaps pointing lower. It's bearish order flow essentially right there going lower. But on the time frame where you will have candle signs, you will likely also already have fair value gaps. So here, there's a daily time frame. And on the daily time frame, we will have candle signs, but we will also have order flow already looking at multiple candles, meaning we have lower time frame fair value gaps versus a higher time frame fair value gap sitting right there. So this is where the adding happens. Why? Because that is where we had the most recent order flow lag. That is where we can confidently say we have been bullish right there. Order flow has been bullish overall. We never create a daily fair value gap going lower right there. We never create even the illusion that we might be going lower right there. So at this moment in time, which one will likely win? Well, with the understanding that we had bullish order flow right there seen through those fair value gaps, then afterwards, we come into a premium array. Will that one win? Well, all right, it might win because this would be a first sign that we might create a bearish fair value gap. But until that moment in time, we only have lower time frame fair value gaps. So is the higher time frame fair value gap stronger than the lower time frame fair value gaps? Yes. So what will win right there? This bullish order flow will just simply continue higher right there. And that is the exact example that we have been using as well, where this right here is the unloading line that I used. And this right there is, again, that adding line. Or sorry, this right there is the adding line that I used right there. That is the fair value area. Now, that screenshot was, again, taken somewhere last night. And at that moment in time, I understood the fact that if we currently want to continue higher, then we have nothing else to deal with than bullish order flow. That's all we have right there. So this became an overall understanding. And in the forecast, it became a full understanding of the following. we came into this fair value gap right there. And whilst we came into this fair value gap right there, we then have a low close. So is the first candle right there rejecting? No, it's not really rejecting. So what can we expect? A previous day low sweep right there to then create the rejection, because that is the next discount rate right there. And then off of that, we can then, for the next candle, continue higher, because ideally we should now create a new fair value gap as soon as possible. Why? Because here we have an order flow lag right there. Once we come into that order flow lag, does that order flow actually want to hold? Well, let's look at candle signs right there. And what we are then doing, candle signs, we are looking at lower time frame order flow to see if we want to confirm the higher time frame order flow to actually continue higher. And if we want to do that, then candle signs comes in. And from that candle signs right there, we will do what? We will ideally want to create a new fair value gap as soon as possible off of the previous fair value gap. So we have 1, 2, 3, and then we have the expansion phase right there. The expansion phase of a new potential fair value gap being created right there. And that is exactly what that looks like, where the respect of this candle signs right there, of that high, is just, again, it's 4-hour fair value gaps going lower, where the 4 hour is not even confirming order flow to continue lower. So this, when we run into this, this will be resistance. It will, because we will mess around a little. Right there, which is also a different topic that we will go over, but it will not push price lower because, again, we have stronger bullish order flow right there on the daily time frame, and the 4 hour right there needs to be in context of whatever the daily is doing right there. So we understand the example, the case study right here on the left, and why I mentioned, all right, we can continue high right there and we are adding orders right there instead of unloading them. Then the next part is right here. This is a complete different example. And this example is very funny because it's what I like to call 50-50 order flow right here on the daily time frame. It's quite 50-50. Why? We are looking at a swing high right there. That swing high, if we look at that, is getting respected based on candle signs again. We then continue lower. We then have this swing low. It's also getting respected. So we're respecting that pre rate and also respecting the discount rate. What is the differentiating factor right here? Well, what was order flow overall doing? Well, order flow right here, this is the previous fair value gap. We came into that and we failed to create a new bullish fair value gap. Makes it difficult. So on a daily time frame, this is quite 50-50. Like, what are we going to do right there? That is exactly where now, a time frame below that, what is the order flow doing? Here we have Euro New Zealand dollar, the example we showed right there in the PowerPoint. And again, we can see that we talked about this order flow right there going higher. We talked about order flow. If it wants to continue higher, we should ideally create a new fair value continuing higher right there. So whenever we fail to do that, we fail to create a new fair value higher right there, do we actually want to continue lower, or do we, like we saw on GBP Canadian dollar actually, let me show you that really quick, or do we, like this example where we also failed to create a new daily fair value higher, just simply want to still continue higher after that? Well, there's a difference between this price action right here and the other time frame I'm going to show you. This price action is where when we fail to create a daily value gap, we only have a 4-hour value gap right there going lower. We don't have order flow right there on the 4-hour confirmed. But if we take a look at Euro New Zealand dollar again, then what we will see is that once we came into, on the daily right here, once we came into this 4-hour right there, the daily swing high right there, and into the daily swing low right there. How do we know that we will actually target that low? And how do we know that we will want to continue lower and we don't have to pay attention to this respect of that swing low and we might not be sweeping it? Well, on the 4-hour, what are we actually seeing right here? At this moment in time, we create a bearish fair value gap sitting right there. And afterwards, the difference between GBP Canadian dollar right there is that this bearish fair value gap is actually being respected to continue lower, to now confidently say that we can target that low. And afterwards, that leads to a new 4-hour value gap lower as well, which leads to what? Leads to the understanding that once we sweep this low on a daily basis, which creates indeed a bullish 4-hour value gap, but at this moment in time, what is the order flow that was most recently established? So which order flow side right here is actually established? It's always been bearish order flow. We never had bullish order flow at that moment in time. So this right here is understanding, all right, on the daily, it's almost equal. It's quite 50-50. On the daily, we did have bullish order flow continuing higher, but we failed to create a new bullish fair value gap higher right there. Failed to create a new order flow leg. That becomes suspicious. So on the 4-hour right here, how do we know when both the premium rate and the discount rate are getting respected right there? Well, on the 4-hour, that's where the order flow comes in right now. Which order flow side is actually established? The bearish side or the bullish side? We never created a new bullish order flow leg right there higher off of this fair value gap. And that is extremely important to understand as well. So understanding how we then look at candle signs in comparison as well, or well actually equal to order flow and seeing through the time frames, then that leads us to the next point, which again is practice. Practice right here. Again, I would advise mark out all the different PDRAs that we have. You can study candle signs in between as well. And as well, study then in combination with candle signs, study how order flow is delivering as well. So simply looking at those time frames, very important, and then looking at those lags. That's what my advice would be. Look at those order flow lags and the time frames, and then eventually we can add into candle signs as well again. So now we have gone over candle direction, we have gone over order flow direction as well. So we are putting now the